If you are a first-time home buyer and you are in the process of getting approved for a loan and you are wondering what the best type of loan for your situation is, you've come to the right place, because by the end of this video, you will have most of your questions answered as it relates to real estate finance. And if you're new to the world of real estate investing, stay tuned to the end, because at the end of this video, there will be a link to another video about how investors find good deals and how investors analyze deals. And I go through some of the metrics that are important to consider. And if you're a first-time home buyer, that is a great video to watch, because it will give you a more in-depth understanding of how to know whether or not a property is a good investment. So if you're a first-time home buyer, for all intensive purposes, I'm going to set the stage by saying what I'm telling you in this video is just my opinion, so take it with a grain of salt, and after watching this video, make your own decisions. In general, I believe that all first-time buyers should focus on getting their first piece of property with a 30-year fixed-rate mortgage. Now, the important words to note on your loan is a 30-year amortization schedule, which I'll explain what amortization schedule means here shortly, and that is a fixed rate mortgage. The reason you want a 30-year amortization schedule is because it's going to give you a lower payment and it's going to be easier to cash flow a property like this if you do decide to rent it out in the future. Now, what is an amortization schedule? An amortization schedule is typically how long-term loans are structured, and it's in a way that serves the bank because the majority of the interest is front-loaded over the course of that 30-year note. For example, in your first 5 years, you might only pay down the principal by 10% of the original loan amount because the majority of your payment is interest. Your last few years of payments are mostly principal, whereas during the first few years, your payments were mostly interest. Now, just to do a little housekeeping on definitions, let's define that. Simply put, principal is the amount that you owe, and interest is the profit that the bank takes in exchange for taking the risk of lending you the money. Think of it this way: interest is what keeps the bank interested in giving you the money, while the principal is the remaining amount of debt you owe. Now, if you're scared of debt and you think you want to pay off your house as soon as possible, subscribe to the channel and watch some of our other videos, and hopefully by the end I'll have you convinced that debt is actually the key to wealth. The key is that is only true provided you're not over leveraged, meaning you don't have too much debt and not enough cash or not enough liquidity. And the reason you want a fixed rate mortgage is so that your interest rate does not increase. Now, this video was filmed as of July 2023, and as of right now, if you had purchased a home 2 years ago with a variable rate or adjustable rate mortgage, you would be hosed right now like a lot of commercial and corporate Wall Street landlords are, because your debt cost would have gone up drastically over the past 2 years as interest rates increased. This is why, until you know what you're doing and have plenty of cash reserves, it's good for a beginner or newbie real estate investor to get fixed rate debt on their first few properties. That being said, the first piece of real estate I bought was actually a commercial building, and I used a hard money loan to get it. But the reason I went that route was because I was a newer business, and the process to get approved and get into the property and then refinance out of it a few months later made the purchase a lot easier than if I had gone with a loan that had to be underwritten by the SBA. Now, all underwriting means is approval. When you hear the term underwriter, that is simply a division inside the bank or lender that is making sure you are a worthy borrower and are qualified to purchase a home and will be able to make payments once the loan funds. But if you are buying a residential property for the first time, which is probably what 99% of people watching this video are considering, then this doesn't apply to you, and you want to think 30-year mortgage. You do not need a hard money loan for your first deal, and something with a fixed rate. When I bought that commercial property, it was at the bottom of the market, so I was not at a high risk of not being able to refinance later, and I had also put 30% down, so as a result, I was fairly confident I would be in a position to refinance later. Now, I could literally end the video right there because I gave you my opinion about the type of loan you should get as a first-time buyer, but there's a few more considerations I want to go over explaining how lending on real estate works, so that way you are familiar and don't get sold on a different type of loan product and understand the pitfalls of other types of loans. If you are a seasoned investor, chances are you're not watching this video because you've bought and sold real estate with multiple types of loans, but for the newbie, we will break it down for you so you know what other loan products are available and what else is out there. Now, the first loan product I mentioned earlier, called hard money, simply means high interest rate debt that typically comes from a private lender. For example, I was paying 10% interest only on that money, and it had a 2-year balloon payment, which meant I had 2 years to pay off the property in full or refinance the debt. Now, the benefit of using hard money in a purchase is that I was able to close and fund the deal in a few days since I didn't have extensive underwriting guidelines to go through. However, the downside was that I had a higher interest rate and that I had to put more money down as soon as I purchased purchased, and I only had 2 years to refinance out of that loan, which could have put me in a sticky situation if I didn't know what I was doing. So hard money loans almost always have balloon payments, and this is because private lenders are not big banks and they want their money back, and they generally want their money back soon and on time. Oftentimes hard money lenders are literally just wealthy individuals that lend out their money and want to make back 10 to 12%. Now, if you're going through a traditional lender like a bank or regional bank or mortgage company like Rocket Mortgage, for example, or an online lender, they will have lots of different loan products like a 15-year fixed product or a 5/1 ARM, a 3-year ARM, a home equity line of credit, and there are literally hundreds of creative types of financing available through lenders, and each of these products typically have different benefits. Now, typically the trade-off is going to involve a combination of two things. Number one is ease of approval. For example, the hard money loans I mentioned earlier were easy to get approved for, provided you had plenty of cash, and he didn't even care what my credit score was because he was using his own money. He just wanted to make sure I had 30% down, and that was enough to give my lender confidence that I was going to make sure to pay him back and pay off the loan within the 2-year period. This had less underwriting, so I was able to move on the deal quickly. Now, the number two consideration is rate and payment. Typically, 30-year rate mortgages carry a premium and will be higher than a 5-year or 3-year rate mortgage that is fixed for a short period of time, and that's a main benefit to getting a 3-year ARM, for example, because if you were trying to maximize cash flow and we were in a low interest rate environment, which we are not at all at the moment, and you were confident that you'd be able to refinance later, a 3-year fixed rate mortgage might be a good option, especially if you planned on renovating the property, because the value of your property will increase after renovations, and when you refinance in 1 or 2 years, you're going to have a long-term fixed rate mortgage at that point. And in the meantime, you'll enjoy a lower rate and therefore lower payment for the first few years. For example, let's say the 3-year rate was a 3%, but the 30-year fixed rate from that same lender was a 4%. That could affect your payment by several hundred or even several $1,000s a month, depending on the loan amount. And from a cash flow perspective for an investor, every penny counts, and interest expense is a write-off anyways, so most investors are just trying to maximize cash flow. Again, I don't recommend you do this as a first-time home buyer because you don't know what you're doing yet, but it is good to be aware of the different options that are out there, because on your second or third deal, there are other loan programs available that might be a better fit for what you're trying to accomplish. But again, on your first, it is going to be get a less risky loan. Get a loan that is 30-year fixed because you know what your mortgage payment is going to be every single month until it's paid off or until you decide to refinance. And chances are a few years after purchasing, you'll be able to refinance either into a lower rate or to cash out on your equity in your property. So your first deal, having a fixed rate mortgage payment, is typically helpful and gives first-time buyers peace of mind knowing that their monthly expense is not going to increase. And the reason this is important is because technically your property taxes will go up every single year, so your monthly payment will still go up slightly as is, but having a fixed interest rate ensures that your debt payment does not increase, and for most people this provides some peace of mind. So hopefully you found this content helpful, and let me know what you think in the comment section below. Did you find this informative, and do you still have questions? And if you haven't subscribed to the channel already, make sure you do so, and please make sure you smash that like button for the algorithm if you haven't done so already. We put out daily and weekly content on how to invest in real estate and keep you up to date on the latest housing market trends. And as promised earlier, right now there's a video popping up on the screen about how real estate investors find good deals, so make sure you check that out if you haven't done so already. Thanks again, and we will catch you on the next episode.